Hi everyone, I'm Basil Neelambra, SBR Tutor at Kaplan School of Accountancy and Management, a platinum approved learning provider. In this video, I'm going to debrief requirement A3 of SBR International March-June 2022 question, Luna Company. So let's read what is A3. The A3 requirement is stating using the exhibit 1 and 2 only, present the extract that should be included in consolidated statement of P&L of Luna Group for the year ended 31st March 2026. Your answer should include revenue, cost of sales, and profit of Starlight attributable to non-controlling interest. It's a 4-mark question. So basically, they're asking you to prepare a few things. One, revenue. Second one, cost of sales and profit attributable to NCI for the year ended 31st March 2026. So I'm going to use this workspace to type this. This is not a pre-populated one. A3 extract of statement of P&L for the year ended 31st March 2026. They're asking us to show revenue, cost of sales, and profit attributable to non-controlling interest, or you can simply write NCI as well. So if you have learned financial reporting, you know that in revenue, there are 3 items that we have to record in statement of P&L. One, parent company revenue. Second one, subsidiary company revenue. And third one, less intercompany revenue. So they're asking us to use Exhibit 1 and Exhibit 2. So let's read Exhibit 1 and Exhibit 2 and understand who is the parent company, who is the subsidiary company, and other information required to prepare revenue, cost of sales, and profit attributable to non-controlling interest in consolidated statement of P&L. So this is Exhibit number 1, sale of shares in Starlight Company. Luna Company acquired 80% equity shares in Starlight. So Luna is the parent and Starlight is a subsidiary company. So in revenue, we will show the parent company revenue, that is Luna Company, that is parent company revenue, plus subsidiary company revenue, that is Starlight Company revenue. And if there is any intercompany revenue or intercompany sale, we have to remove it. And similarly, in cost of sales, we will normally include 4 items in cost of sales. You might have already learned this in financial reporting paper. We have parent company cost of sales, that is Luna Company cost of sales, subsidiary company cost of sales, that is Starlight Company, and less intercompany purchase. Intercompany sales will be deducted from revenue and intercompany purchase will be deducted from cost of sales. And we have one more item, add unrealized profit on closing inventory. On closing inventory. Then you will get cost of sales. So now let's read the question. Luna Company acquired 80% of equity interest in Starlight Company on April X2. Starlight Company had in issue $1 million one equity share and has not issued any shares for many years. Remember, our financial year ending is 31st March X6. So the financial year will be from 1st April X5 to 31st March X6. So all this information is before this year information. Goodwill on acquisition was correctly calculated as $320,000, but had subsequently been impaired by 15% in 20x4. Luna Company values non-controlling interest at fair value. The fair value of net asset of Starlight at acquisition exceeded their carrying amount by 200,000. This all related to non-depreciable land which is still owned by Starlight Company at 31st March X6. On January X6, that is our current year, Luna Company sold 100,000 equity shares in Starlight for $7 a share. The only reserve within equity in individual statement of financial position of Starlight is retained earnings. The balance of this reserve at April X5 was 4,658,000. Starlight generated a profit for the year ended 31st March 20XX of $165,056, which accrued evenly throughout the year. So this information is given for the purpose of calculating profit attributable to NCI. So we can say that our financial year ending is on 31st March X6. So the financial year will begin on 1st April 20X5 and end on 31st March 20X6. And what happened on January X5? Luna Company sold 100,000 equity shares in Starlight. So on April X5, you can say that beginning, Luna Company has acquired 80% of equity interest in Starlight, and the number of shares in Starlight is 1 million. So Luna Company has got, we can say that on April X5, Luna Company has invested 80% of 1 million. So 1 million into 80%, Luna Company has got 800,000 shares in Starlight Company. So 800,000 shares out of 1 million shares, we can say that the parent company percentage is 80%. Parent company percentage is 80%. So NCI will be 20%. So this is from 1st April X5 to 1st January X6. 1st January X6. So this period NCI is 20%. Then what happened? On 1st January 20XX, Luna Company sold 100,000 equity shares. So now parent company has got only 800,000 minus 100,000 shares was sold 700,000. Still it's 70%. 700,000 of 1 million share, 70%. So it's decrease in control. So parent company right now has 70%. So NCI would be 30%. So from 1st January X6 to year end 31st March X6. So we can say that from 1st April X5 to 1st January X6, non-controlling interest is 20%. So how many months are there? April, May, June, July, August, September, October, November, and December. 1st January is just 1 day, so don't take it. So from 1st April X5 to 1st January X6, 9 months. How much is the profit? Starlight generated a profit for the year ended 31st March X6, 1,655,056. So not 1 million, 165,056 is the total profit for the year. We don't have an entire year from April to January. It's 9 months into 9 by 12. So we'll get the profit for 9 months. And during this 9 month, NCI has 20% share. So into 20%. I'm using this 0.00, second last one to round off this figure. And from 1st January XX to 31st March XX, it's 165,056. That is a profit for the entire year. From January X6 to 31st March X6, 3 months. And in this 3 month, NCI has 30% share. So 12,379. So from April to January X6, 9 month, NCI is 20%. And from 1st January X6 to 31st March X6, NCI is 30%. So the percentage of NCI is changing. That is why we are time proportionating it and multiplying with the share of profit of NCI. So that's it. So the 9-month 30% share and the 9-month 20% share and 3-month 30% share, NCI profit attributable to NCI is 37,138. That was one of the requirement that was asked in A3. Your answer should include revenue, cost of sales, and profit of Starlight attributable to non-controlling interest. Profit of subsidiary company attributable to non-controlling interest. We have answered that particular portion. Now we have to answer how much will be recorded as revenue and how much will be recognized as cost of sales. They're asking us to using exhibit 1 and 2. So from exhibit 1, using the profit of subsidiary company given in exhibit 1, we have calculated profit attributable to NCI. So definitely the figures that is applicable for revenue and cost of sales will be there in exhibit 2. So let's read exhibit 2 and calculate the revenue and cost of sales. So reading exhibit number 2, sale of goods to Starlight Company. Remember, Starlight is a subsidiary company. On 20th March 20XX, Luna Company sold 5,000 units to Starlight Company at an initial transaction price of $200 per unit, and control of goods passed from Luna Company to Starlight Company on that date. So parent company has sold 500 units of subsidiary company at a transaction price of 200,000. So we got one of the information. There's an intercompany sale. So intercompany sale, we have to deduct intercompany sale from revenue. So that is equal to 5,000 units multiplied by 200 is a selling price. So intercompany sale is 1 million. We are deducting that, so minus. So for one company, the parent is selling it. So it is intercompany sale for the parent. Whereas Starlight, subsidiary company is purchasing it. It's intercompany purchase. It should also be deducted. So the intercompany sale should be deducted from sales, and for another company it is purchase, it will become intercompany purchase. It should be deducted from cost of sales. So we have done that. Payment is only due when Starlight Company sells goods on to the end consumer, which typically takes around 6 months. Starlight had not yet sold any goods on to final consumer as at 31st March 20XX. So that means there is a closing inventory, and we will have to add back the URP on closing inventory in cost of sales. We'll have to remove it. So remove it, we have to remove URP on closing inventory. Removing it, we'll have to add back to cost of sales. The goods have a high risk of obsolescence, and therefore price concessions are regularly granted in order that goods can be easily transferred on within the distribution channel. On the basis of past practice, Luna Company anticipates that it will grant Starlight Company a price concession of between 8% and 38%. Current market data suggests that a maximum price concession of 35% may be necessary to enable Starlight Company to distribute the goods to final consumer. It's information for some other requirements. The initial cost of goods to Luna Company was $80 per unit. So parent company bought this goods for 80, and parent is selling these goods for $120 per unit. That means parent is making a profit of 120 per unit. So we can calculate URP from this information. So parent company, I'm just scribbling it here. So parent company is acquiring this inventory at a cost of $80, and parent company is selling this at a selling price of 200. So there is a profit, which we can say unrealized profit because it is between parent and company. So 200 minus 80, unrealized profit per unit is 120. How many such units have been sold by parent to subsidiary company? It is given in the beginning of the exhibit 2 itself. On 20th March 20x6, Luna company sold 5,000 units to Starlight company. So unrealized profit, which have to be added back 5,000 units multiplied by unrealized profit 200 minus 80, 120, 600,000 is URP on closing inventory. It will be added back in cost of sales. There's a format of cost of sales: parent company cost of sale, subsidiary company cost of sales minus intercompany purchase, add unrealized profit on closing inventory. And if the question asks you to include anything else like depreciation or amortization or any other expense in cost of sales, you'll have to include that as well. But this four items is the normal thing that will there be always in cost of sales in consolidated statement of P&L. Let's continue. Starlight company has included goods within their closing inventory at a value of 1 million. Definitely yes, because Starlight has purchased this at $200 for 5,000 units. So 5,000 units into $200, 1 million will be the price that Starlight might have recorded. Revenue and cost of sales for the respective entities for the year ended 31st March X6, revenue and cost of sale, both companies given. Now, the most important thing is that should be time proportionate subsidiary company figure? Answer is no, because it is still a subsidiary company. There is no sale of subsidiary company. There was a loss of control is there, or decrease of, not loss of control, decrease of control is there that will affect the non-controlling interest. 20% become 30%. Other than that, it's still a subsidiary company. No time proportionment required for subsidiary company figure. It's still a subsidiary company. So now let's complete this. So revenue, Luna company revenue, that is parent company revenue, 29,812,540 plus subsidiary company revenue, Starlight company revenue, 14,185,160 and intercompany revenue, 5,000 units sold at 200, 5,000 into 200, 1 million. It should be deducted. Now, the consolidated revenue will be parent company revenue, 29,812,540, subsidiary company revenue, 14,185,160 minus 1 million intercompany sale. So that would be consolidated revenue will be 42,997,700. Now, cost of sales, parent company cost of sales, 18,154,020 and subsidiary company 11 million or 40 to 120. Intercompany we have already discussed 5,000 intercompany purchase into 200 and URP on closing inventory we have discussed 120 into 5,000 units. URP should be added. So summing this, parent company cost of sales 18,154,020, subsidiary company cost of sales 11 million or 42,120, intercompany purchase 1 million which have to be deducted and URP on closing inventory which should be added 600,000, summing it. So it's 28,796, 160 is the cost of sales. And we have already discussed profit attributable to NCI is already discussed. So I hope you have understood this preparation of consolidated SOPL extract. All the best for your SBR examination.